Hello, I'm Mark Absey, Head of Indexing at Thematic Research, and welcome to the week ahead. Before we get into this week, let's take a look at what happened last week, and we did have a bit of a busy week. Monday started off with some mild panic attacks as Berkshire A shares seemed to plunge almost 100%. Of course, this was not the actual case. Turned out there was a pricing glitch up at the NYSE. It was fixed pretty quickly, and the trading day continued without incident. On the back end of the week, of course, we had our good friend Mr. Roaring Kitty announce he was having a webcast, and although there was speculation that he would do all kinds of wonderful things and turn himself into a billionaire in the process, that did not happen. So a little bit of fear and misunderstanding in the beginning of the week, and a little bit of, oops, what did I just do at the end of the week? But still, all in all, not that bad. In terms of the major indexes, tech exposure was the place to be, and that was evidenced by the major indices and their returns. So the Dow up about 29 bips, the S&P 500 up 132, and the NASDAQ Composite up 238. So clearly, more tech exposure equaled a better week for you. Now, the Russell 2000, which as of late has taken to be the market's breadth indicator, did not share in any of that. It was actually down about 210 bips on the week. Sector-wise, again, tech leading sector. Healthcare was up there as well. Still lots of Ozempic euphoria, I guess. And then, of course, communication services and consumer discretionary, which, as we know at this point, are the tech, comm services, and discretionary are the homes of the various Magnificent Seven constituents, although Tesla, increasingly, people are wondering if that should even be included. We saw trade-off energy and utilities. Utilities, of course, have had a pretty big run, and they've been trading off as people get more confident in what's going on in the economy and their ability to anticipate what the Fed is doing. Now, in terms of anticipation, while not the entire Fed, certainly the Atlanta Fed had a very busy week because they basically had GDP forecast updates every day this week, and they started off by shocking everyone, dropping their forecast to 1.8% for Q2, and every day it came steadily up and up until Friday. Based on the employment figures, they bumped it back up to 3.1, which is actually a little higher, about 0.4% higher than where it ended last week. So at least the Atlanta Fed is feeling good about things. Now, when we think about the numbers from an econ perspective, the jobs report came out, and it was good because, oh great, we had net positive jobs, and that's good. But at the same time, the unemployment rate itself ticked up to 4%, which is a level it hasn't seen in over 2 years. Tucked within that as well, we saw some decelerated spending from consumers, as well as a slight uptick in credit card delinquencies. So again, not kind of major warning signals, but at the same time, things to watch out for. Okay. Talked about GDP. Of interest, when you're looking at the S&P 500, or at least the various select spider sectors, interesting to note that the top 3 performers for last week, and yes, NVIDIA was in that mix, but it wasn't number 1. So the top performer last week for S&P names, believe it or not, Carnival Corp, about 10.74%, NVIDIA, 10.27%, and with the successful launch of Starliner, we saw Boeing finally get back on the board, up about a little over 7% on the week. So some interesting things there. I know I said it was tech heavy, but there were some individual names in there that were still doing some good things. And frankly, even though, broadly speaking, breadth in kind of the rest of the market, kind of the small cap market, the mid cap market, et cetera, isn't playing out, at least among large caps. We're not so concentrated. So it's good to see that those stories are coming out. Now, when we look at this week, basically we have more inflation. We have more inflation stuff. Well, we certainly have more inflation, but we also have more inflation numbers coming out, right? So Wednesday, we're going to get May CPI figures. And again, we're looking here, year-over-year figures steady at about 3.4%. Core year-over-year, slightly lower, about 0.1% lower to a 3.5% handle. Now, of course, this isn't really anywhere near the 2% that the Fed has been aiming for the last few years, but slow and steady wins the race. I don't know. We'll see what happens. Thursday, continuing claims, they're expected to take about 8,000 higher to an even 1.8 million. And initial claims are expected to take a little lower, about 2,000 lower to 227,000. Also, on Thursday, we're going to get PPI figures. Now, this is interesting because basically, PPI on the month-over-month for both top line and ex-food and energy are expected to have declined. Top line down about 40 bips, ex-food and energy down about 20. However, the year-over-year figures are still showing increases. 30 bips on top line and 10 bips on the food, ex-food and energy. Okay. Friday, we get an updated Michigan sentiment number, and I know the last number we got, people were a little concerned because dip below 70. The reality of it is that since June of 22, Michigan, the sentiment number basically bottomed around 50, and that was around June of 22, and it's basically been kind of making higher highs and higher lows as we go along. So its latest peak was just below 80. We saw a big drop, but we're now seeing a bit of a rebound, and so we're looking for over time, of course, that higher highs and higher lows as that upward trend continues. In terms of the models, we do, well, basically last week was interesting because the tech-centric models basically ruled the roost, with the exception of our EPS diplomats model, which was the best performing model over the week. But following right behind it was the AI, cloud, digital privacy, and CHIPS Act models, which were, 4 of the top 5 spots. Okay. In terms of what we're looking for this week, I already went over the econ figures. Honestly, it's still going to be a mixed bag as to what the Fed is going to do, or what people think the Fed is going to do. If you look at the last 4 easings, right, the Fed has not preemptively done anything, and generally speaking, they are not preemptive on easings. So the pain that Powell was talking about a year and a half ago, clearly he doesn't feel, and the Fed doesn't feel like we have seen that yet, despite all these small warning signs. He's really gonna need to see some fire and not just some smoke on this. So it's not clear to me that they're going to cut, even though we've seen the ECB in Canada cut. But at the same time, if they were to step in and actually raise rates, again, I don't know that I see that happening either. Of course, they have a window, I think, of a couple more meetings, basically until we really get into the election cycle. Well, the final stages of the election cycle, anyway. So, I don't know that I see anything happening in June. And again, as we get closer to November, in as much as the Fed is an independent body, again, I don't know that I see any changes in rates, basically until after the election, right? And whether that's up or down, I don't know. My kind of hope is that it goes down, that they cut a little, but at the same time, I think that what they've done so far, it's been a shock of sorts to the economy, but it hasn't been the short, sharp shock that they wanted to really spur a contraction, right? And in a way, we should be thankful for that, because if they really did kill the economy, then that would be a whole other thing. But still, this is starting to feel kind of like death by 1,000 cuts. So without any cuts. So I don't know. Again, I'm not a Fed prognosticator by any means, and just listening to me, you can tell that. But my kind of take on it is, there's going to be a fair bit of the same over the summer, and of course, as we get closer to the election, I'm really not looking for the Fed to do all that much. I think that's about it, honestly. Like I said, we are on the model side. We're still paying attention. We're still paying attention to nuclear. We are keeping our eye on the tech-heavy or the tech-focused models. And as always, we do keep an eye on what's happening in our market hedge model, because that, of course, does come into play, and as we have seen, can be helpful in mitigating risk. Okay, so that's about it for now. Just a housekeeping note: we will be off next week, both Chris and I. So we'll be skipping a week, but we'll be back in 2 weeks with another week ahead video.